Let's recap where we are. By comparing McDonald's valuation metrics to its historic metrics, the investor suspects that if consumer preference swings back to established fast food restaurants, then McDonald's earnings will rebound. Were the PE to at least remain the same, the shares would then go up. By comparing McDonald's valuation metrics to its peers, he sees that the low PE is justified for now by the weak revenue growth outlook. If McDonald's were indeed to grow again, there is a chance that the PE ratio may even rise. But let's not forget one of the drawbacks of relative valuation. It presupposes that the peer group is in aggregate fairly valued. If the whole industry is overvalued, then the peer group valuation could lull the investor into a false sense of security. The way he guards against this is by comparing the metrics of McDonald's to the overall market to make sure that McDonald's is not on a dramatically higher multiple than the overall market. The World Equity Index function has columns displaying both the PE ratio and the dividend yield of the S&P 500, which is the main equity index in McDonald's domestic market, the U.S. The PE ratio of the index is 18.5 times, while McDonald's is 19.3 times, meaning that it is trading roughly in line with the U.S. market. The dividend yield of the index is 1.99%, while McDonald's, recall, is 3.53%, making its shares very appetizing in comparison to the broader stock market. On every relative valuation measure the analyst has examined, McDonald's looks like a buy. So he goes ahead and buys shares in McDonald's, hoping that they go up over the next year. His investment thesis that consumer preference would return to McDonald's after the arrival of the new CEO turned out to be correct. On October 6, 2015, McDonald's started selling all-day breakfast in a signature initiative by the new CEO. McDonald's customers had been demanding this for years, and it proved to be a highly popular move which lured customers back to McDonald's. Meanwhile, recall that investors expected Chipotle to grow very quickly. Starting later that month, October 2015, Chipotle restaurants suffered from an E. coli outbreak, causing consumers to stop going to Chipotle. Let's revisit the chart of McDonald's earnings, PE, and share price that the investor looked at in March 2015, but fast forward a year later. We can see that 1. The quarterly earnings rebounded to $1.2 billion as the CEO engineered a turnaround in the earnings. 2. The PE rose from 19.3 times to 25 times as investors began to expect earnings growth for McDonald's as a result of the turnaround. 3. Therefore, the share price rose from $96.90 to $124.61 as both earnings and the PE ratio rose. If we pull up a share price chart of McDonald's and the former stock market darling Chipotle for a one-year period after the investor did the relative valuation, we can see what a lucky pick McDonald's was compared to Chipotle since the news for each broke in the autumn of 2015. You will now appreciate the power of the framework we use to explore the valuations of Apple, Microsoft, and McDonald's. Remember, Earnings multiplied by the P/E ratio gives you the price, and so variation in either earnings or P/E ratio explains movement in the price. You can glean a lot of valuation insights by simply plotting earnings, P/E, and the share price of a company onto one chart. As we conclude the equities module, we can use this framework to shed light on why the overall stock market is so volatile. These same forces are at work for the stock market in some as we saw individually for Apple, Microsoft, and McDonald's. Overall, corporate earnings drive the overall stock market. Let's demonstrate this by running an analysis over the 20-year period that we discussed at the start of the equities module when the stock market tripled, halved, doubled, halved, and tripled again. We can employ the same framework to analyze the S&P 500 by using aggregate earnings instead of a single company's earnings, by using the overall P/E of the index instead of a single company's P/E, and by using aggregate market cap instead of a single share price. This process effectively treats the overall S&P 500 like a single stock. Here we can see the overall P/E ratio of the S&P 500 and the total net income for all index members. The P/E ratio of the S&P 500 peaked at 30 times during the dot-com boom and hit its low point of 12 times during 2011. Earnings for the overall S&P 500, meanwhile, was close to $1 trillion at the end of the period, but had gone negative during the financial crisis. The earnings, therefore, fluctuated far more than the P/E ratio. If we now layer on the aggregate market cap for the S&P 500, we can see how the three lines relate to one another. At the end point of the chart, the S&P 500 had $972 billion in aggregate earnings, while the P/E ratio was 16.9 times. Therefore, the aggregate market cap of the S&P 500 was $16.43 trillion. Earnings, therefore, was the main driver of stock market volatility over this period. This is why earnings season is so fascinating to stock market investors. Let's focus on the relationship between earnings and the stock market. When earnings declined after the dot-com boom, the stock market halved. When earnings recovered after the start of the Iraq War, the stock market doubled. When earnings went negative in the financial crisis, the stock market halved. And when earnings roared back after the financial crisis, the stock market tripled. Not only was the market cap of the S&P 500 correlated with the aggregate earnings, but turns in the earnings trend appeared to immediately precede the turns in the stock market. While earnings may look like a leading indicator on this chart, recall the mechanics of how companies release their earnings. They come out 3 or more weeks after the quarter ends. So the turning points that you observe here are in reaction to earnings announcements. The moment it is clear from company earnings that the earnings trend has turned a corner, the stock market moves immediately to take this into account. This chart is a good illustration of why investors are obsessed with earnings season. If only we could predict turnings in the corporate earnings cycle, then untold riches could be ours by simply buying or selling shares ahead of a turning point. Well, the main driver of corporate earnings is the state of the economy. We can demonstrate this by overlaying real GDP growth onto this chart. When the economy craters, as it did in the dot-com bust and the global financial crisis, the overall stock market invariably goes down a lot. As PMI and jobs reports are the strongest leading indicators of real GDP growth, and as real GDP growth drives corporate earnings, and as corporate earnings drives share prices, it is no wonder that the Friday jobs report and a 50-person survey from Arizona have the world's stock market investors' rapt attention. We began the equities module by equating the stock market to a roller coaster. Roller coasters are subject to the law of gravity. On Wall Street, this law is called reversion to the mean, and P/E ratios are subject to this law. Recall the Apple and Microsoft examples in which the P/E multiples drifted down to teen levels as the companies matured, Also recall that the PE of the S&P 500 consistently reverted to mid-teen levels. The gravity analogy breaks down, however, when we consider corporate earnings. They are not subject to the law of gravity because they link to the economy, and the economy has grown strongly since the Industrial Revolution. Provided the economy is favorable and a company is successful, its earnings can just keep growing, and accordingly can pay a growing stream of dividends, as we saw for Coca-Cola. This is why share prices can, in practice, go up tens of thousands of %. So now you see that while the stock market can appear to be a roller coaster ride in the short term, many believe it to be a one-way bet over the long term. This is why financial advisors recommend that young people allocate most of their retirement savings to equities. After all, world GDP, as we saw at the start of the Economic Indicators module, just keeps growing and growing. As always in finance, there is a snag. Stock markets, by and large, list companies based in the same country as the market, meaning that they are to a large extent exposed to their home economy. So to invest with confidence, one must be confident of the economic outlook in that country. Let's demonstrate how different economic outcomes over the long run can lead to different equity returns. We will look at two contrasting countries over the same 1994 to 2014 period that we've previously studied. U.S. GDP rose from $8 trillion to $18 trillion. The S&P 500 index, assuming reinvested dividends, multiplied six-fold over this same period. Meanwhile, Japanese GDP actually shrank from $5 trillion to $4.5 trillion. The Nikkei index, assuming reinvested dividends, barely rose. Recall that Japan was struggling to regain growth after the 1980s boom. The received wisdom that stocks always go up in the long run is built on the critical assumption that the relevant economies keep growing. You need to have a point of view on things like demographics, productivity, and technology, and be lucky enough to dodge periods of upheaval. Think you've grasped these concepts? Answer these questions to check your understanding.